First of all, what is order flow? Order flow is the study of how orders interact and how transactions actually occur inside the market. To understand order flow, you need to understand one core idea. Markets are an auction. At any given moment, the market shows two prices. The highest price a buyer is willing to pay is the best bid, and the lowest price a seller is willing to accept is the best ask. The difference between these two prices is called the spread. The spread represents the gap between liquidity providers on both sides of the order book. Below the best bid and above the best ask, there are additional passive limit orders resting at different price levels. These orders create what we call the depth of market, the visible liquidity available beyond the best bid and best ask. For example, below the best bid, you may find more buy limit orders stacked at progressively lower prices. Above the best ask, you will find more sell limit orders stacked at higher prices. These resting limit orders provide liquidity to the market. They are passive because they do not move price on their own. They simply wait to be executed. How does price actually move? Every time a trade occurs, an order must be matched with an opposite order. This process is handled by what is called the matching algorithm, the engine of the exchange. When an aggressive buyer sends a market buy order, the matching engine executes that order against the lowest available ask, the best ask. If the available liquidity at that price is fully consumed, the engine automatically moves to the next available ask level. And this is how price moves up. Liquidity is removed level by level inside the order book. The same process happens on the downside. When aggressive sellers hit the bid with market sell orders, the matching engine executes against the highest available bid. If that liquidity is exhausted, price moves lower to the next bid level. So what you see as a candle moving higher or lower is not random movement. It is the visible result of liquidity being matched and consumed inside the order book. Price does not move because there are more buyers than sellers. Price moves because aggressive participants are willing to accept worse prices in order to get filled immediately. Whenever one buy contract matches one sell contract, 1 unit of volume is recorded. Every transaction generates volume equal to the size of the matched orders. Volume is simply the record of executed transactions. Now that we understand how volume is created, the next question is, how do we measure aggression? This is where delta comes in. Delta measures the difference between volume executed at the ask and volume executed at the bid. But it's important to be precise here. Delta only measures aggressive orders. When a trade executes at the ask, it means a market buy order lifted the offer. When a trade executes at the bid, it means a market sell order hit the bid. Delta is calculated as ask volume minus bid volume. So if aggressive buyers are lifting the offer more than sellers are hitting the bid, delta will be positive. If aggressive sellers are dominating, delta will be negative. But remember, delta does not measure total interest. It does not measure resting liquidity. It does not measure limit orders sitting in the book. It only measures executed aggression. And that distinction is crucial. Because you can have heavy, aggressive selling with strong negative delta, but if passive buyers are absorbing that selling, price may not move lower. Delta shows initiative. Price shows whether that initiative is accepted. And the interaction between the two is what gives real insight into market behavior. In many trading platforms, delta is also displayed in cumulative form. This is called cumulative volume delta, or CVD. CVD simply sums delta values over time, creating a running total of aggressive activity. If delta is positive, the cumulative value increases. If delta is negative, it decreases. So instead of looking at single bars of aggression, CVD shows the overall initiative pressure building during a session. Now that we understand delta and aggressive activity, the next question is, how do we visualize that activity inside each candle? This is where the footprint chart comes in. Instead of seeing only open, high, low, and close, a footprint shows how much volume traded at the bid and how much traded at the ask at every price level during that period. Each price level inside the candle contains two numbers. On one side, the volume traded at the bid, aggressive selling. On the other side, the volume traded at the ask, aggressive buying. This allows us to see not just that price moved, but how it moved. For example, a bullish candle might look strong on a normal chart, but inside the footprint, you might discover that aggressive selling dominated most of the move. That difference is crucial, because footprint charts reveal the internal battle between buyers and sellers at each level of the auction. They allow us to see where aggression was concentrated, where volume was heavy, and how participation evolved within a single candle. The footprint shows us aggression per price level. It gives a deeper view of participation inside the auction. There is one important detail about how footprint charts are read. They are not read horizontally, they are read diagonally. The reason is simple. Aggressive orders execute across the spread. This is why footprint charts are read diagonally. The diagonal relationship reflects how trades actually occur inside the order book. It allows us to understand how aggressive activity is progressing from one price level to the next. Diagonal reading does not tell us direction by itself. It simply aligns the footprint with the mechanics of execution. It ensures we are reading order flow in the same way the matching engine processes orders. Now that we understand aggression and execution, we need context. And this is where volume profile comes in. Volume profile is rooted in auction market theory. The core idea is simple. Markets tend to distribute volume in a bell-shaped curve, often referred to as a Gaussian distribution. In statistics, the bell curve is commonly used to describe how a continuous variable distributes around a mean value. In markets, that variable is traded volume at price. When the market is balanced, most of the volume concentrates around a central area. This distribution reflects where buyers and sellers found agreement. Instead of showing volume over time like a traditional histogram below the chart, volume profile displays volume traded at each price level. It answers a different question, not when did volume occur, but where did volume occur? And that shift in perspective is crucial because markets do not move randomly. They rotate around areas of agreement and expand away from areas of disagreement. When analyzing a volume profile, one of the most important concepts is the value area. The value area represents the range of prices where approximately 70% of the total traded volume occurred during a session or selected period. In simple terms, it defines where the market spent most of its time and activity. Inside the value area, buyers and sellers were in relative agreement. This is considered the balanced region of the auction. The lower boundary of this range is called the value area low. The upper boundary is called the value area high. These two levels define the extremes of accepted value for that session. When price trades within this range, the market is operating inside established value. When price moves outside of the value area, the auction is exploring either attempting to discover new value or rejecting previously accepted prices. At the center of the value area lies the point of control, or POC. The POC is the single price level where the highest amount of volume was traded. It represents the price of maximum agreement during that period. So while the value area defines the broader region of balance, the POC identifies the exact price where participation was highest. Together, VAH, VAL, and POC provide a structural map of value within the auction. So now you understand what order flow really is. It's not magic, it's not prediction, and it's not a shortcut. It's the study of execution. It's understanding how liquidity is provided, how aggression is measured, how volume is distributed, and how auctions build value. Most traders look at candles and try to interpret patterns. But behind every candle, there is a constant interaction between passive liquidity and aggressive participation. That interaction is what actually moves the market. When you understand microstructure, delta, footprint, and volume profile, you stop guessing. You start reading participation, and that is the foundation of professional trading. In the next videos, we'll go deeper. We'll talk about absorption, exhaustion, failed auctions, and how to interpret advanced order flow concepts in real market conditions. But remember, master the foundations first, because without understanding how the auction works, no setup will ever make sense. If this video helped you clarify what order flow truly is, leave a like and subscribe to the channel. And if there's a concept you'd like me to break down in detail, leave it in the comments, and do not forget to leave a like and subscribe to the channel. See you in the next one.